the official Consumer Price Index inflation figure rose to 4.2% year over year, the highest annualized rate seen since the post-COVID price surge of 2022. This by itself was not a great result, even though these official numbers really just confirmed what most people already knew. Things are getting more expensive, but what they didn't capture is what is likely to still be coming down the pipe. Last month, the Producer Price Index, which tracks a basket of items that businesses use to provide goods and services to consumers, saw its largest single increase in the last decade, with the only exception of a single month at the height of post-pandemic inflation. Now, the reasons are pretty obvious. Fuel prices trickle through to almost everything that needs to be transported, sprinkle in persistent tariff uncertainty, market consolidation, and a lot of resources being redirected towards data center buildouts instead of providing service infrastructure to regular people and businesses. Now, eventually,
What they need to change is that basket number or whatever items they're counting in the basket because, they'll say 4.5%, but you can go buy meat or even produce, and some of the prices have increased like 30%, especially meat. So I don't know how they use some basket number to make things sound better and say like 4.5%, or it's like when gas jumps from 3 something to $5, that's like 40% increase.
these companies will either be forced to accept lower profit or just pass these higher prices along to consumers, which will ultimately be a decision made for them by how much more those consumers can financially bear. Again, not exactly surprising stuff anymore. And if anything, the cost of living crisis we are currently experiencing is arguably not as bad as wider economic conditions might suggest, for now at least. But the implications of these numbers are worth understanding because they are likely to mean a lot more than just yet even higher prices. This kind of inflation is putting a new Fed in a very difficult position. The logical move would be to raise interest rates, but that runs the risks of sweeping out the last leg holding up the economy, which is the stock market. A stock market that is already gearing up to digest 3 mega IPOs in the next few months. The other options involve either sacrificing the American consumer, the American worker, or the American dollar. The other unfortunate reality worth keeping in mind is that no matter what we do with our financial levers, we can't print more oil, and any price increases from here are going to be on top of a cost of living level that was already forcing a lot of people to go without.
Are you concerned, Mr. President, about the latest inflation number which came out this morning? Could that be a
No, I love it.
for
The
Republicans
numbers were
to
great.
try and
You know what I really
hold
love?
Senate?
I love the inflation.
Spending all of that money on housing, food, childcare, transportation, health, and taxes, there's nothing left over. And it's hard to imagine that if I'm making $120,000, I'm barely making it.
The numbers at the gas pumps keep going up.
$5.39, $5.59, and $5.79. This is ridiculous. We went from 3s to 5s.
Domestically, we've got about 216 million barrels of gasoline available to us. That seems like a lot, but 190 million barrels is considered critical.
Okay, so inflation has clearly been creeping up, and that's on top of levels well above what would be considered optimal. But for now at least, there are, or at least were, a few things that have been shielding us from the full effects of just how unaffordable things have become. The first of those sacrificial shields is that we have been burning through inventories. In early 2025, companies stocked up on anything and everything they could keep in their warehouses, mostly in an attempt to get ahead of tariff disruptions. And where possible, they've just been using those stockpiles to keep prices competitive for as long as they can. In the first quarter of 2025 alone, businesses added around $172 billion worth of inventory, which, according to government GDP data, was the largest quarterly inventory buildup outside of the pandemic recovery in records going back to the 1940s. This obviously doesn't apply to perishables that can't be stored indefinitely, but specifically, things like component parts and other goods were piled up in bulk. Small businesses didn't have a warehouse to do this, so mostly this has been a benefit to larger retailers and B2B suppliers. A big box retailer could fill distribution centers with a year's worth of patio furniture before the tariffs landed. The local warehouse buying through a distributor got a few extra weeks' stock at best, which was kind of part of the plan. For big companies, this was an opportunity to run anti-competitive pricing without actually running anti-competitive pricing. Because in theory, it wasn't their fault that their smaller market rivals didn't order supplies before a 30% tax was slapped on everything. Obviously, this isn't great, but for consumers and end producers, it at the very least delayed price increases. When the tariffs hit, Goldman Sachs estimated that companies were only passing along about a fifth of the cost increases to consumers. A year later, their estimates put that figure closer to 3/4, and still rising. Researchers at the Fed went a step further last month and described what we are seeing now as, full pass-through. So that cushion is mostly spent. We still don't 100% know what is happening with tariffs either. The Supreme Court struck down the biggest batch of them in February, but the White House has still been going back and forth on new ways to get around these rulings and re-implement something in its place. For now, since the first round of tariff rules weren't legally enforceable, the government will, at some point, have to pay back around $166 billion in refunds to about 330,000 importers. Money that is unlikely to find its way back to consumers. This refund...
See, that's why that doesn't make sense. So you're going to tell me that they're going to refund all the tariffs back to the importers, which most of them raise costs on products that was passed through to the consumer. But where's the refund to the consumer? So it's like at the end of the day, we get shafted. They should do a rebate. If they get a refund, these companies need to do some type of price slashing to give you a rebate.
Process has been incredibly slow and administratively difficult, which is again disproportionately impacting smaller businesses that don't have the time or the manpower to wait for this cash. There was also a lot of speculation around these rulings, with certain companies buying the rights to tariff refunds before they were confirmed. They would go to businesses and pay them some money to write up a contract that would entitle them to tariff refunds if and when they were ever handed back. One trade attorney at Foley & Lardner reported getting hundreds of emails a day offering to buy his clients' refund claims, with offers that started around 20 cents on the dollar. So yeah, apparently this is a whole industry now. A lot of desperate small businesses took those pretty crappy deals just to get some money back to make payroll. The investors themselves have made 400% returns off this desperation within the span of just a few months, which is clearly how the free market ought to be working. Now, arguably, these investment firms still accepted the risks that these tariffs may never be paid back, in which case they would lose all the money they paid to these businesses. But it probably didn't help that the actual architect of the tariff plan in the first place also had direct interest in an investment firm betting against the legality of those very same tariffs. Now, even outside of particularly egregious examples like that, this financialization of government tools is making it particularly difficult for smaller businesses to compete. But the point here is that once inventories run dry, we will be more directly exposed to the increased prices to actually make or import stuff, which at the moment is climbing about 1.5 times as fast as the headline inflation number. Now, the reason why this pressure on small businesses is such a big deal is because larger companies aren't going to cover this gap forever. They have accepted tighter margins for now, because they realize that...
I call cap on that. I think a lot of these large producers like the Walmarts and even the Targets of the world, I think they like to kill small businesses because they get to have more consumers. They get to consume more of the market. They can make it seem like, oh, they don't like certain rules and regulations, but it benefits them in the end. It's like when the small business closed, who do you think people would go to? Or where do they shop? They shop at Walmart. And Walmart's everywhere. They just build a bigger Walmart.
That there is only so much consumers can bear. But if smaller businesses are pushed out of these markets, there won't be much competition left stopping major retailers from passing along these input price shocks and then some. So yeah, this inventory drawdown has been softening the inflationary blow for the last 12 months, and that's the first layer of armor that has more or less been used up. But within the last 100 days in particular, there has been one inventory cache that we have been drawing on harder than ever, and that's our Strategic Petroleum Reserve. So to learn how money works to find out how much longer we can hide away the real inflation problem. This video is sponsored by Odoo. Odoo is the company's private stockpiles have quietly been absorbing a lot of the price pressure for the last year. But the one doing the heaviest lifting right now belongs to the federal government. The Strategic Petroleum Reserve is quite literally a huge pool of oil kept in 4 separate underground caves, which is in theory made for times like this. If we need a stabilized supply, and by extension prices, during unstable times, we can draw down these reserves to put more oil into the market and avoid huge swings. It's pretty simple, but it won't last forever. According to the Department of Energy's own numbers, the reserve held about 411 million barrels at the start of the year. As of last week, it was down to around 349 million, sitting at under just half of its theoretical maximum of 711 million barrels, after weeks of the large.
Have you noticed that anytime they deplete the strategic reserves, the prices hardly ever drop? Like it doesn't make a significant difference in price drop when they deplete the reserves. So I don't understand how it's stabilizing the market. Because even the Biden administration was depleting the reserves too to stabilize prices when prices were jumping to like $6-7 a gallon, and still it might have dropped like 25 cents on the dollar. I mean 25 cents per gallon, not even on the dollar. That's way too much.
Drawdowns in its history. The rate at which we have been drawing oil from, it would be fine if the conflict in Iran really did only last a few weeks, but we are now more than 3 months in, and despite recent peace talks, there is still a long way to go before things get back to normal. The US has committed 172 million barrels to the Coordinated International Release, and completing that commitment would leave the reserve at its lowest level since 1982, directly following the most severe oil crisis in history, which for context took place over 2 years to get to where we are now.